All right, we've been all over the place today. We were down, we were up, down, up, and a few more of those in there. We're down right now, down 94 points. It was right around this time that things got really crazy yesterday, but, well, they've been really crazy today. We've had swings of around 900 points today. I can tell you right now, telecom, healthcare, energy, all leading us lower right now. And why are we lower right now? I mean, what has changed, right, in the last couple of weeks that suddenly has made everyone more concerned? I'll tell you what it is. Inflation. The fact that inflation might actually happen because we've basically had none of it ever since the Great Recession. And the idea that that could come back, that's an adjustment for people. It means that we'd have higher interest rates. The Fed would be raising rates. Investors don't like that in part because, well, suddenly there's competition. People can say, hey, maybe I should put my money in a fixed income bond instrument that will give me a guaranteed rate of return plus my money back at the end of the coupon. Or I could put my money in the stock market and take a bit of a wild ride. So competition's good. Joining me right now, economist Doug Holtz-Eakin from the American Action Forum. I say, you know what? I love this idea of returning to normal here because it scares me when the 30-year is trading where it's been trading. It's as though people don't think there's going to be any inflation 30 years from now. And that's a rather pessimistic attitude, if you ask me, Doug.
I think you've got this about right. I mean, a big chunk of this is simply that worldwide monetary authorities have switched from these extraordinary monetary policies and are normalizing what they do. And with the world no longer awash with cash and them buying up all securities, you have competition between fixed income and stocks again. That's business as usual in the big picture, and people will get used to that. I do think there's part of this inflation story that people got wrong, however. I mean, I think the notion that somehow on Friday we saw an employment report that showed 2.9% average hourly earnings growth, scared everyone to death, just doesn't fit the math. I mean, suppose we got wage growth at 2.9%. We have productivity at 1.1%, so the inflation pressure there is 1.8%. That's below the Fed's target, nothing to be afraid of. So it may be that people are just not figuring out what to react to. They certainly shouldn't be concerned about that.
Now, that's an interesting point. Let me also ask you, I mean, everybody's saying, okay, the Fed is going to raise far more aggressively. Do you think there's a chance that they don't?
I think it's really kind of interesting. We've seen two things happen in the past 3 or 4 days. One is a whole bunch of folks who said that the tax cuts would never work are now saying, oh, my God, they work too well. We're going to get all this inflation. The Fed's going to have to move. And, well, I mean, it's got to be one or the other. I mean, they have a little consistency there. But if the tax cuts work the way I expect them to with all those business tax reforms, that's pro-investment, pro-innovation, pro-productivity. As we said, productivity takes inflation pressures out. So I don't think there's anything to be concerned on that front. It may be the case that the Fed raises more aggressively. Why would they do that? Because the new neutral funds rate is higher than they thought. That's good news. Throw me in that briar patch. Why the Fed's raising rates is what matters. And if it's because we have a stronger economy, it's going to grow more rapidly on average.
A second ago, and you said, why do you think the Fed would raise? You're saying not because of inflation, but because of?
Because neutral is higher, and they got to get to neutral. And that's a good thing. If neutral is higher because we have a faster growing, more productive economy, that'd be great.
Because you can't have interest rates at zero forever. And we're not at zero now, but we were at zero forever. And what do you do if you actually have a crisis that you need to fight? Right, Doug?
You've got lots of room then. The Fed has an extraordinary power still on the downside. Downside risks they can take care of. I think the real question has been, what's their upside room to maneuver? And it looks like now there's a lot more than there was before. And that's something you have to take into consideration.
All right. Interesting stuff. Douglas Holtz-Eakin, thank you.